Okay, just to set the stage now, if you've invested in Indonesia or if you talk to any foreign investors in Indonesia, one of the top issues and top concerns that are often faced and often come up in discussions is the Indonesian tax environment. Now, Indonesia, I think recognizing some of these problems from investors, has been doing a lot over the past few years to try to reform some of the tax laws and the tax environment, although it still does remain a challenging tax environment to do business in Indonesia. So after President Jokowi entered his second term, there was a proposal for this omnibus law, which you heard in the opening remarks mentioned. Now, the intention of the omnibus law was to try to change a whole bunch of different laws all at one time, hence the name omnibus, in order to improve the investment and business environment in Indonesia and to stimulate job growth. One of the major parts of the omnibus law did relate to the tax laws and trying to improve the tax environment in Indonesia. Now, this was originally proposed back before this whole COVID pandemic started. And then once COVID hit about a little more than a year ago, basically the omnibus law got put on hold. But the Indonesian government did not want to delay some of the tax reforms, and therefore, about a year ago, President Jokowi issued an emergency tax law change by presidential decree that was then later entered into law. And that particular tax law change about a year ago encompassed some of the originally proposed changes in the omnibus law. And some of the other changes then were finally subsequently passed when the omnibus law was passed in November of last year, and implementing regulations have only been issued in February of this year. So starting with the changes about a year ago, the major change that was, I think, very welcome and quite an improvement was to the top-line corporate income tax rate. So before last year, the corporate income tax rate in Indonesia was 25%. So under last year's emergency tax law change, the rate was reduced to 22% for 2020 and 2021. And then from 2022 onwards, the corporate income tax rate in Indonesia will be 20%, which is quite reasonable by international standards. Further, listed companies may be able to further reduce their corporate income tax liability by an additional 3%. So after 2022, that means down to 17% corporate income tax rate if certain conditions are met. So again, a pretty reasonable corporate income tax rate. However, it is also important to note that Indonesia does have, at least in my experience, a somewhat unique alternate tax system that is applied to certain industries. And most notably for today's discussion, the final tax regime is applied to the construction and real estate industry in Indonesia. And I'll explain that a little bit later. But having the final tax regime can create a lot of challenges for investors and people doing business in Indonesia, because the final tax regime is a tax that's based on revenue as opposed to actual profit. Indonesia does have a VAT system, and the VAT rate is 10%, which again, by global standards, is quite a reasonable VAT rate. Individual income tax maybe is a little bit, some might think a little bit less reasonable. It has graduated income tax rates for individuals, but the top rate is 30%. And that top 30% rate does kick in fairly quickly once a taxpayer is earning above a certain amount of income. Indonesia does have a self-assessment tax system, but at the same time, there is a number of mechanisms that allow the government to collect tax not through a self-assessment system. And I'll get to that in a minute. So Indonesia, which is a little bit different than a place like Hong Kong, for example, does apply income tax for both individuals and companies on a worldwide income basis. Now, there have been some changes that have improved that for things like foreign dividends, which I'll get to later under the omnibus law. So there have been some improvements on the taxation of foreign dividends. Back to my earlier comment about a number of mechanisms to assist the Indonesian government in collecting taxes from taxpayers, there is quite an extensive withholding tax system. And this applies not only for foreign transactions or transactions between Indonesian and non-residents, although there are withholding taxes on that, but this withholding tax system also does apply for domestic transactions and even applies on things like imports. So what this withholding tax system does is allows the Indonesian government to collect a lot of the corporate income taxes and individual income taxes up front, which are then reconciled once the taxpayers do their self-assessment and annual tax filing. There are various penalties and sanctions for non-tax compliance. I'm not going to get into that today, but there was a major change under the omnibus law that was mentioned. So the penalty rates used to be at a fixed amount per month, mainly of 2% per month. But under the omnibus law, they have changed to a variable rate that is set by the government plus an additional amount depending on the type of penalty or non-compliance. One thing to keep in mind is that there is a 5-year statute of limitations in Indonesia. So what that means is that up to 5 years after an income tax return or our withholding tax return is filed, the Indonesian tax authorities still can conduct a tax audit. Now, I'm going to discuss just briefly tax audits because that is one of the biggest headaches that investors have, and that goes, just go back to the previous step. So if you look at that last bullet point on the last slide, the government does have a very high expectation and annually sets tax revenue targets very aggressively. What this creates is an environment where the tax authorities, and in particular the tax auditors, have very high revenue collection targets when they're conducting tax audits. This can often result in major assessments on companies and a lot of tax disputes with the tax authorities that then often have to go to court. Now, it's also important to note that, as I mentioned, there's a self-assessment system, but there's also this extensive withholding tax system. One of the things that creates a lot of headaches for businesses in Indonesia is that anytime a taxpayer files a tax return that requests a refund. So for example, let's say that over the course of the year, because of the previously mentioned withholding taxes, the amount of prepaid income tax of a taxpayer is higher than their actual corporate tax liability, and they have to file a corporate income tax return that shows a refund. Before they can receive that refund of overpaid tax, there's a mandatory tax audit. And if we go to the next slide. So then what happens with a tax audit is after the filing of a tax return that requires a refund, the tax authorities have up to 12 months to complete that tax audit. In more cases than not, that tax audit will usually result in a tax assessment or a reduction of the refund claimed, which is often a subject of dispute. And there is a dispute process in Indonesia that can take quite a bit of time. Even though ultimately a lot of taxpayers are successful once they go through the whole process. But usually it starts with a tax objection to be filed within 3 months. And if that is not successful, then there is a process to go to court through a tax appeal. And there's several levels of that ultimately oftentimes taxpayers end up filing an appeal with the Supreme Court. So the whole process from tax assessment to resolving a tax dispute can take a number of years. So this is an important business consideration because in those several years, a lot of funds are often tied up. So I can move on now. So as I mentioned earlier, there is a unique tax system or alternate tax system in Indonesia, which imposes a so-called final income tax on construction and real estate business, also some other businesses, but for today, I'll focus on construction and real estate. So what this means is that taxpayers in these industries, rather than having a traditional calculation of taxable profit and then application of the corporate income tax rate to that profit, they instead have a final tax rate applied to their gross income. And that is typically withheld by the one that's paying them that income. So in the case of construction work, depending on the type of construction work and the size of the construction business and the particular license that the construction business has, the final tax rate on construction income will either be 2%, 3%, 4%, or 6%. Again, that is usually withheld by the project owner or contractor from the income that is paid to the construction company and then remitted to the tax authorities on their behalf. And then when the construction company files their income tax return, if the taxes have been properly withheld, they shouldn't have anything else to pay in terms of income tax because it is the final tax on the revenue, and there is no issue with calculation of profit. Now, the one thing I'll caveat on that is that for foreign construction companies that do operate in Indonesia through a branch, there is an additional branch profits tax, and the branch profits tax is done under the traditional corporate income tax calculation. So this also creates some issues. So the local branch would have the final tax on their income, but then in order to calculate the branch profits tax, they would have to do a traditional taxable profit calculation and apply the branch profits tax to that. If we move from construction to the actual real estate investors, real estate business is also subject to a final income tax. So if we're talking about building and selling land and building, this is subject to a final income tax of 2.5%. Again, this is withheld by the buyer and paid over to the government on behalf of the seller, and it's a final tax. So after that, there should be no more income tax due on the transfer of land and buildings. However, I will mention, it's not on the slide here, from a buyer's perspective, there also is a transfer duty on land and building, and that is equal to 5% generally. So the total transfer of land and buildings will usually have a 7.5% transfer tax and duty liability. In the case of the rental of land and buildings, this is subject to a 10% final tax. Again, the renter withholds this and remits it to the government on behalf of the property owner, and then they should not have to pay additional tax. Now, this final tax system does create some challenges because, and in some cases maybe makes things a bit easier, but because it's a final tax income and there is no actual calculation of taxable profit, there are also no tax deductible expenses in the company. So a lot of the tax management mechanisms that are done in countries that have traditional corporate tax systems will not be applicable in Indonesia because of the final tax system. For example, trying to create deductions to manage your tax liability through things like debt financing, etc. So we can move to the next slide. So as I mentioned, the VAT in Indonesia is 10%, which is, again, quite a reasonable rate. This is for transactions that are conducted within Indonesia. If there is an export of services, then there is a 0% rate. But obviously, in the case of export of services, that would probably not be an issue for this audience. That would typically be for Indonesian construction companies doing construction services outside of Indonesia. In terms of import of goods, there's also import VAT, again, 10% on the import value of most goods. But there are certain VAT facilities that are available for the import of certain capital goods and equipment. So that could be quite relevant in the construction industry. Now, an important thing to note about VAT, it is a traditional VAT system of inputs and outputs. So generally speaking, VAT should not be a tax burden for companies in Indonesia. However, it can still be a financial burden for companies because of what I mentioned before. So many times VAT will be due upfront, for example, on purchase of high value assets, on advanced payments of income and things like that, and would then be recovered through an output mechanism when the company makes sales. In principle, if there's an excess amount at the end of a year, a company should be able to file a VAT return to request a refund of that excess VAT. But because of the previously mentioned mandatory tax audits, anytime you file a return for a refund, oftentimes companies that do file for the refund of that excess VAT can take years to get that VAT back. And as well, because of the mandatory tax audit, a lot of taxpayers choose not to file a refund claim and rather carry forward excess amounts until such time as they can absorb it through output VAT. So again, this can create a financial burden and a time value of money issue as to when you can recover input VAT. Okay, move to the next slide. There are a number of concessions on certain types of special projects and special zones. So foreign loan funded and grant funded projects done through the Indonesian government. So meaning, for example, if a foreign government is providing aid to Indonesia for certain projects, then contractors working on those projects may be eligible for certain tax benefits. As well, there is a provision, both in previous law and the new omnibus law, for certain tax facilities for public-private partnership. However, the details of those facilities are not yet clear or known, and we're still implementing regulations on that. There are also certain tax benefits in special zones in Indonesia, including free trade zones, special economic zones, bonded zones, and integrated economic development zones. Now, these can be import tax and customs duty facilities, and there can also be income tax facilities for investors in those zones. But unfortunately for the construction industry, because it is, as I mentioned, subject to final tax, most of the income tax concessions are not applicable. So we can move to the next slide. So just moving to what I mentioned previously, so there was the omnibus law that included a lot of different law changes. So it changed aspects of the investment licensing rules. It changed aspects of the so-called, what used to be called the negative investment list, which was the restrictions on foreign investment in certain businesses. It changed laws on workers' rights, and as I mentioned, it also changed laws on taxes. So I'm just going to highlight a few of the major tax law changes that were part of the omnibus law. So if we move next. So this one was quite a welcome change in the omnibus law. So under the omnibus law, the government was granted the right to reduce the withholding tax on interest paid to non-residents in the case of bonds. Under the law itself, the rate was not stated, but it was indicated that the government would issue regulations to change the withholding tax rate on interest paid on bonds to non-residents. So without this concession, the normal withholding tax rate on interest is 20% when paid to non-residents. Now that rate can often be reduced under an applicable tax treaty, which we'll get to later in the presentation. But one of the problems with Indonesia is that it is often very difficult to apply tax treaties because of very strict anti-treaty shopping and beneficial ownership rules. So this reduction of interest withholding tax on bonds paid to non-residents is quite welcome for a number of foreign investors. and it will kick in August of this year. So after August, you can have the 10% rate. If the treaty happens to have a lower rate, which is actually quite rare because most treaties only reduce the rate to 10%, but if the treaty does happen to have a lower rate, then you can still apply the lower treaty rate if it applies. Okay, so move to the next slide. Okay, so as I mentioned earlier, Indonesia does have a worldwide tax system. So Indonesian taxpayers are generally subject to tax on their worldwide income. There were a number of important changes in the omnibus law with respect to dividends, both domestic dividends in Indonesia as well as dividends received from overseas. So starting with the domestic dividend rules, before the omnibus law, if an Indonesian tax resident received a dividend from another Indonesian tax resident, so an Indonesian company paid a dividend to another Indonesian company or to an Indonesian individual, there was a exemption only if it was a dividend received by a company that owned at least 25% of the shares in the other company. And in the case of individuals, a dividend received from an Indonesian company was subject to a 10% final withholding tax. Under the omnibus law, this has changed so that now all dividends paid and received between Indonesian companies will be exempt. And in the case of individuals, as long as that individual reinvests the dividend into certain designated Indonesian investments, they can also be exempt from income tax on dividends received from Indonesian companies. Also, quite a good change is that for foreign dividends received, both by individuals and companies, prior to the omnibus law, they were subject to full tax, which meant if it was received by a corporate, it would be subject to the current 22% income tax rate, and in the future 20% income tax rate. And in the case of an individual with a top 30% individual income tax rate, previously they would be subject to tax at the rate of 30%. Under the omnibus law now, if the individual or company receives the dividend and again reinvests it or a certain percentage of it into certain designated Indonesian investments, then the dividends will no longer be taxable. So this is quite a benefit, particularly for Indonesian companies and individuals that own shares in companies overseas. Okay, go on to the next. Okay, so there were a number of very welcome VAT rule changes in the omnibus law. The first one here, imbrang, or what we call so-called in-kind capital injection or contribution. Previously, it would have been subject to VAT, but under the new omnibus law, if it's a in-kind capital contribution between two VAT taxpayers, it will no longer be subject to VAT. Now, again, this might not seem like such a big deal under a traditional VAT system because of input-output mechanisms, and normally VAT should be recoverable. But as I mentioned before, because of the tax audit rules and the aggressive tax authorities and a reluctance to incur tax audits, oftentimes if there was a VAT on a business reorganization with in-kind capital contributions, it could have taken taxpayers years to recover that. So this exemption on VAT for in-kind capital contributions is quite welcome. Another very important one, and this is particularly important in the construction and real estate industry, is the ability now to claim creditable input VAT during the pre-production period. This was a particularly difficult issue before this omnibus law change in the construction and real estate industry because land acquired for purposes of construction used to be subject, or still is subject, to VAT. But under the previous rules, there was an interpretation that land was not a capital good. And under the previous rules, in a pre-production period, only capital good VAT could be recovered. So under the previous rules, in a land purchase, there was at least a risk that the VAT on a land purchase could not be recoverable. The omnibus law has now clarified that in all cases, even for non-capital goods, pre-production VAT will now be recovered. There's also some provisions that allow the crediting of input VAT that was incurred prior to a taxpayer being registered for VAT, which also was often an issue in the real estate industry, because often a company would not be registered for VAT at the time they acquired land or even buildings, and that under the previous law, that VAT would not be recoverable. So under the omnibus law changes, it can now be recovered. Also now, VAT that is collected through tax audit assessments can also be recovered, and previously it could not. Next slide. Okay, this is another important one, particularly in the construction industry. So VAT during pre-production used to be recoverable, as I mentioned, if it was VAT incurred on capital goods. Under the omnibus law change, now all VAT recovered during pre-production can be recovered, but there is a caveat, and that is that the company needs to be in production. And by production, what we mean is basically they have to start delivering taxable output goods. So if you're building a building, it means you have to start either selling it or renting it. Same for other things like infrastructure projects. They need to start operating within certain periods. So it used to be generally 3 years that all taxpayers had to start production in order to recover the VAT. Under the omnibus law, for certain types of business, it has been extended. So for manufacturing companies, now 5 years, and for strategic infrastructure projects, 6 years. And that's important from a construction company perspective because you need to be able to complete construction in time for your customer to be able to recover their VAT. Okay, move on to the next slide. On the tax treatment in relation to sovereign wealth funds, this is, you may have heard, the sovereign wealth fund has been established by the Indonesian government under the omnibus law. The intention of this sovereign wealth fund is to use both Indonesians' money as well as attract money from foreign investors, including foreign governments and foreign institutional investors, to invest in strategic projects in Indonesia, such as infrastructure. So the sovereign wealth fund will be cooperating, as you can see on the bottom part of the slide. They can establish a fund either by themselves or in cooperation with third parties. So there's an opportunity for foreign investors to participate in projects with the sovereign wealth fund, and there will be some tax benefits for that. So if we move to the next slide. So these are some of the tax benefits that are applied to the sovereign wealth fund itself. So I think this is not really interesting for this audience, so we can move to the next slide. The interesting one for foreign investors that cooperate on projects with the sovereign wealth fund is that there will be a benefit on the taxation of dividends received by the non-residents. So there's two types of dividends. So for the first type, and that is deemed received when a project is completed and liquidated, that will be non-taxable if it is reinvested or used in another project in Indonesia within 3 years. If it's not vested or for any other dividend, including normal profit dividends, there will also be a benefit that the dividend income tax is reduced to 7.5% from the normal 20% non-treaty rate. Now, in the case of Hong Kong, that might not be so interesting, at least if you can qualify for treaty benefits, because the dividend rate under the Hong Kong Treaty for substantial investment is 5%. But as I mentioned before, it's often very difficult to qualify for treaty benefits, so this could still be of interest and benefit for those that aren't able to qualify for the lower dividend rate under the treaty. Okay, go on. Next slide. Finally, I'm just going to mention about the way that foreign companies can invest in the construction business in Indonesia. So move on to the next slide. So there were some changes in the omnibus law, although in substance they're pretty much the same as previously. So unlike most businesses in Indonesia, which require the establishment of a local company to do business in Indonesia, the construction business does allow the concept of having a commercial branch, or what we call a public works representative office, which means it's just a branch of the foreign construction company. And through that branch, you can conduct construction activities in Indonesia. Again, that branch will be subject to the final construction income tax and will then have the regular branch profits tax applied to it. One of the restrictions and requirements, though, is that the PWRO, or Public Work Representative Office, is required to participate in projects together with a local construction company. So they can't do projects on their own. There are also some minimum capital requirements of the entity that is establishing the rep office to do construction, and the head office of the entity does itself have to be a construction company. So the other option for investing in Indonesia and conducting construction services is to establish a limited liability company in Indonesia, or so-called PT company. And this is possible with foreign ownership. However, it is not possible for such company to be 100% foreign owned. So a foreign construction company wanting to establish a subsidiary in Indonesia is required to have a local partner. That local partner is required to be a local construction company. And in the general restriction rules, they need to, the foreign owner can only have up to 67% of the local construction company ownership. There is an increase in that allowable ownership to 70% if the investor is coming from an ASEAN country. So as I mentioned, there were some changes under the omnibus law. We're still waiting for the details, for example, on the joint operation requirements that I mentioned, that a public works rep office needs to cooperate with a local construction company on projects. So we're still waiting for further implementing regulations on that. Next slide. As well, the omnibus law has tried to simplify and make a bit easier the business licensing rules for all business, including construction business. So it's moved to a risk-based licensing system. However, as I mentioned with the joint operation requirements, we're still waiting for some additional implementing regulations in order to see exactly how this is going to work. But these are the general requirements for business licensing. And with that, I'll conclude my part of the presentation, and I'll hand it over to my colleague, Emily.